In today's episode of the MSA Rental Market Update, we are looking at the Columbia rental market for conventional multifamily properties. As you can see, we have the Columbia Metro Statistical Area drawn out by CoStar here on the map, and you can get an idea of where this is located. Columbia is the capital of South Carolina. You can see here is Charlotte. Here is the Raleigh-Durham area and Fayetteville, North Carolina. We've got Atlanta over here, Birmingham, Huntsville, Alabama here, and here is Nashville and Knoxville, Tennessee, with Chattanooga down here on the south side of Tennessee. So this gives you an idea of where the South Carolina or Columbia, South Carolina market is located. Let's go take a look at our filters, and you will see that as usual, we are excluding all corporate, all military, all senior, and all vacation. We are only including market and market affordable. If we go to location, you'll see we're in market, Metro Statistical Area, Columbia, South Carolina. So let's go take a look at the analytics and see what the analytics have to say about this rental market. We'll look at all three asset classes first, Class A, B, and C together, and then we'll do each individual asset class. So let's go look at the analytics. Here is the supply snapshot for the Columbia MSA. There are 467 conventional properties, totaling 40,652 units. There are currently 1,074 units under construction, and in the last 12 months, 424 more units went vacant than were rented. In the previous 12 months, only 5 units rented then went vacant, which is very interesting. You can see that is a reduction of over 8,000%. Not a good sign for Columbia right now. You could see 12 months ago, the vacancy was 7%, and it is now sitting at 9.6%. We are still showing a year-over-year increase from 1161 to 1199. We'll see what it looks like quarter over quarter. We are not looking at the capital market. We are only looking at the space market. If we scroll down, we can see our long-term occupancy average is almost 91%, and we are sitting at about 90.5% or 90.44 on that long-term occupancy average currently, which means we are slightly below that long-term occupancy average. One can argue we're kind of sitting on it. So when we get to the end, we will plot on the market cycle chart exactly where this market sits. But let's first go look at the data and see if we can confirm what we're seeing on the supply snapshot and take a look at all three asset classes first. Here is the rent analytic data for all three asset classes for the Columbia Metro Statistical Area. We do not look at asking rent. We don't care what the owner or manager is asking for rents. We only care what they are collecting. If we look at the first quarter of 2022, they were at 1163, went up to 1192, kind of stabilized at 1193. So one of the few markets it didn't actually break between the second and third quarter, but then it did break between the third and fourth quarter. So down to 1180 and then back up to 1191. So let's go take a look at our deliveries and absorption and see if it confirms that it should have had that uptick, which we've seen in a lot of markets around the country. So we had 109 units deliver and 245 more units went vacant. Now, interestingly enough, we got to go all the way back to 2021 Q3 where it had positive absorption. So since the fourth quarter of 21, this market has been going backwards in demand. Interesting that we're only seeing a rent decrease in the fourth quarter of 2022. This data is showing us we should have started decreasing much sooner. So we've had 109 go vacant, delivered new to the market, and then another 245 go vacant here. Then another 291 go vacant and 85 absorbed. So in the second quarter, we had a little absorption, but you can see that the market is slowly ticking down in occupancy. 300 delivered vacant, another 43 go vacant, another 28 delivered vacant, another 359 go vacant, another 4 delivered vacant, and another 47 go vacant. So we saw that tick up in rents, And this is another market, once again, where the fundamental principles tell us it should have gone down in rent. In actuality, in the month of January, it ticked up, which means either the data isn't any good in January for this market, or the ownership arbitrarily raised those rents, because at 90.4%, we are below that 93 percentile that the ownership likes to keep it before they start lowering those rents. So very interesting that it's taking this much time to start lowering rents with these occupancies down to 90%. All right, let's go see if there's a specific asset class that's holding this market back. And we'll look at the Class A properties first. So here is the Class A rent analytic data. There are 29 properties totaling 6,113 units. Looking at effective rent, we started at $14.55, went up to $15.17, and then it broke. So between second and third quarter in Class A, we had that break. Went down to $15.10, down to $14.92, down to $14.75. So interesting that we did not get that uptick in January in this market, which we have seen in other markets. So let's see what deliveries and absorption tell us. Well, we've had no deliveries. That means all the deliveries were in the Class B space in this market. And once again, we have a lot of red in absorption. So we had 18 units that were absorbed in the Class A market in the first quarter. So our occupancy ticked up slightly. Had another 58 absorb, occupancy ticked up slightly, and then it's been a negative exodus ever since. So the Class A market's definitely broken. It is only at 93.6, so it is now starting to get to that point where the ownership is getting nervous, and they are lowering those rents so that they can start filling these units up, because these NOIs need to stay strong so that they don't lose these assets if that NOI drops below that minimum debt service coverage ratio. So the Class A demand supply fundamentals reacting appropriately. Let's see what story the Class Bs tell us. Here is our Class B rent analytic data. There are 178 properties totaling 22,395 units. Looking at effective rent in the first quarter, we were at $12.06 of 2022, went up to $12.29, stabilized at $12.30. So there's that $1 stabilization we saw in all three asset classes, down to $12.15, and then back up to $12.30. Let's see if deliveries and absorption tell the same story, or if we see what we saw previously. So we did get a little absorption in that first month of January, so I'm not going to be too disappointed with that rent going up like that. But with our occupancy as low as it is, it surprises me that they went up on those rents, considering this market is so low in occupancy right now. We could see that we had 109 deliver vacant, and then another 171 go vacant on top of that. Prior to that 109 delivering, we had 204 units go vacant. So there's about 500 units going vacant in the fourth quarter of 2021 and the first quarter of 2022. Then another 291 go vacant and only 19 absorb. Then another 300 vacant, no absorption, another 28 vacant, then another 216 vacant. So the fact that it took that long to break tells me they're trying to keep this Class B market propped up because they're afraid of what's going to happen with their NOIs. But now that this is below 90%, so now we can't even get agency debt on these assets. Of course, this is the whole market now. Let's keep that in mind. I'm just generalizing. These owners are going to have to lower these rents, or this is going to turn into a really bad situation for the Class B market. So far from what we're seeing, Class A's, broken, no demand. Class B's, broken, no demand. Let's look and see what the Class C market is telling us. Here is our Class C rent analytic data. There are 212 properties totaling 11,912 units. Looking at effective rent in the first quarter of 2022, it was at 903, went up to 928, went up to 933, and then between the third and fourth quarter, it broke down to 928, and then jumped all the way up to 947, the largest rent we've seen in the market. Now, I'm going to go out on a limb, and I'm going to guess that we're going to see a whole lot of red here over in absorption because we won't have any deliveries or under construction. We're going to have a whole lot of red that's going to tell us that this should not have occurred and that we should have broke much sooner than this. But the fact that it finally did break between the third and fourth quarter tells a story. I'm starting to think that this first quarter data is going to be erroneous. And it wasn't all red, but as suspected, there was absolutely no reason to jump that high in those rents, especially when we're all the way down under 90% occupancy. So very interesting that they had that big jump in rent in the month of January. Again, this data may be a little erroneous. It gets better as we get the full quarter data, but we won't have that until about the middle of April. So we can see that we had 87 went vacant fourth quarter 2021. Another 92 went vacant. Only 88 absorbed. So let's just zero out 22 Q4. So we're at negative 92, negative 182, and negative 259. So negative absorption, Class C market. I did expect to see all red, though. I got to be honest. This is one of the first times we've seen some positive absorption in the Cs. And so that explains why we didn't go down in rent until that fourth quarter. So the Cs almost reacting appropriately to demand supply, but that first month of 2023, that big rent jump that we had from $928 to $947, almost $20 in rent, should not have occurred. The fact that we had no demand there just says that this data is erroneous, or these owners just lifted those rents for no reason. So what does that mean for this market? Well, we know that our long-term occupancy average for this market is 90.4%, and we were sitting right about 90 or 89, well, pretty much right on that line. I think it was 90 point something, one something. So we're just barely underneath this long-term occupancy average. One could argue on the long-term occupancy average. I'd call it on this side of the NOI line because we do have deliveries. We definitely have negative absorption in all three asset classes. Rents are declining except for that January number, which I'm starting to believe is erroneous. So we know we have declining rents. We know we have declining absorption. We know we still have more units to deliver. So I would put the Columbia Metro Statistical Area rental market right here for conventional apartments on the long-term occupancy average. And as we move forward into that first quarter of 2023, I think we're going to see it move down to this point down here. I don't think there's any way that the Class C rents hold where they are. And we already see that the Class B rents are already breaking and did not sustain. And the Class A's were pretty much in the same boat. So we're going to call it right here on the long-term occupancy average. That does it for the Columbia, South Carolina Metro Statistical Area. Stay tuned tomorrow as we finish this week in Northwest Arkansas. I will see you guys tomorrow.